Ever wonder what financial advisors have to say about money goals, the market, or economic issues? If you have, then this podcast is for you. Behind the Designs gives you a sneak peek into the internal conversations at Financial Design Studio. Michelle Smollenberger, a certified financial planner and the CEO here at FDS, will be your host and guide. Welcome to Behind the Designs.
Welcome back. We've just gotten past the Thanksgiving break. We've spent time either with family or just quiet time alone, off work. Hopefully you had a chance to kind of get away, recharge. And so now we're back talking about what's happening, current events, what things are people talking about and we're hearing about, reading in the news. And so one of those big stories really over the last few weeks has been cryptocurrency, what's happening there. Big stories about exchanges not being able to give investors their funds back. So we're really going to dig into this and talk about what's happening. So what happened, just to explain it to people. You know, we've long had this belief on crypto, and so we're going to talk through that. And, you know, we're kind of saying, okay, we're glad that we had that thought. And so, Rob, thank you for all your guidance in that. And
absolutely.
And even a couple weeks ago, we sent an email to clients. So we don't invest in crypto. We haven't. And sent an email to clients, though, because these were questions we were getting, like asking us, wait, I just want to make sure you didn't invest us in crypto, right? And so you drafted this email basically saying we don't invest you in this and we haven't, and which is funny because normally we're saying here's the changes we made in your portfolio and explaining what we have invested in. So it's just funny that we're saying we didn't. So
Yeah, it's I mean, it's been obviously a huge topic the last couple of years, particularly in 2020 and 2021 when all these crypto coin prices were going through the roof and people are asking, hey, you know, what should we be doing with this? And, you know, I guess our stance has always been that it's just, there's so much risk to this. And frankly, there was a lot going on the last couple of years that, you know, it's kind of like if there's fire, or if there's smoke, there's fire. There were just a lot of little things like that going on the last couple of years that at least suggested to me, just based on my experience watching this, you know, these kinds of things happen, covering financial companies for over 20 years, is, you know, it's just like, you know what, something is not right here. And we don't ever want to put client capital into something that we don't fully understand. We don't want to put client capital into anything that even has a remote possibility of going to zero. And, you know, with a lot of these cryptocurrencies, I think that was a legitimate risk, as we've seen play out recently. So, yeah, we've never even dabbled in it. It's not, you know, a dogmatic view or anything, but just the way the industry has been for a number of years, we just could not, in good conscience, think about putting client money in these things.
So when we talk about cryptocurrency, so even going back to kind of what it is, you can mine it yourself. It can be very secure where you own it. You own the password, so it's yours. You own, and I kind of think about this like gold. You own the gold bullion. You know, you actually own the hard asset. These exchanges that people were investing in, they thought that they were buying Bitcoin, but they weren't actually. They were kind of buying shares in the exchange. Is that right? Kind of explain what they were investing in.
Yeah, it's basically, I mean, they were basically buying the price of Bitcoin. So the exchanges, for most people, when they, you know, went out and said, oh, I'm buying Bitcoin or I'm buying, you know, some other currency and all that, they weren't actually buying the currency. They were just buying basically the price of it. And, you know, a paper reference of like, okay, you know, Rob, you own X, Y, and Z Satoshis of Bitcoin. And, you know, did I really own that? Not really. But I had a claim on it. And that's really what I think a lot of people are surprised about right now, is all these exchanges and a lot of crypto industry promoters over the last couple of years have said, you got to own this stuff. This is a way to, you know, get away from the government and all these other things. But at the end of the day, what they were selling people was not actual exposure to the underlying asset. They were just basically selling paper references to these things, and that just basically, it didn't even exist. So yeah.
Yeah, so I guess when you've talked about this over the past few years, because clients have asked us, should we buy some? And this has always been something where, personally, I think sometimes people learn by buying an asset like this, and it could work out well. It could turn out well. So we don't know the future. We don't pretend to. But when we're researching something, we really dig in to say, well, what is it? We learn, what's attached, everything that's attached to it. So we actually know what we own. When you think about, even just experiences you've had in the past, do you feel like for some people this is kind of the way they learn? It's kind of like, oh, okay, I did it and now I learn. Sometimes we kind of have to get that like out of our system as we're almost growing up and maturing and gaining wisdom in investing.
Oh, yeah. Yeah. And I mean, I say this from my own experience. I started my career in the late 90s at the height of the tech bubble. All these .com stocks were going up like crazy. The internet was going to revolutionize everything. And I worked at an investment management company that, extremely seasoned investors, very high quality investors. And, me as a young 20-something and, some of my colleagues and all that are making all this money in these .coms. And it's like looking at the older guys and saying, hey, you know what? I mean, it's a new world out there, guys. You got to wake up and smell the coffee. And they were always like, no, it's a sham. There's nothing here. These companies don't make any money, and it's all going to come crashing down. And it did. And so, that was a really good lesson on my part. It's really easy to kind of think there's something new in finance. And just go through history of finance. There's absolutely nothing new under the sun when it comes to finance. Every scam, every promotion that humans could possibly construct to make money without doing work has been done. So, as we go through these cycles, all it is the same flavor, just looking different. So, back then it was .com stocks, and then it was these crazy mortgages during the housing bubble where you didn't have to have income. You didn't even have to have assets, and you got a mortgage, and that made no sense. And then you come around to crypto, and it's like, just the exact same thing all over again.
Yeah, it's really interesting. So it's kind of a know what you own, also know what risk you're taking. So the amount that you're putting into it, I think it's just all these reminders. And I think at the end of the day, if you were someone who kind of got right out, like, can you make money investing in these things? Yes. But I think natural human tendency is we want to earn money passively without, having to do much work. We want to gamble. We want the quick win. We want the easy money. And that's like just natural. Like, that's a natural tendency. And so it's not even saying like, oh, you're awful if that's you, because I think we all lean that way. We have that tendency.
Oh, yeah. I mean, we've all done it. I mean, that is, if we're honest with ourselves, every single one of us, myself included, is always looking for a way to make money without having to put out a lot of effort. I mean, and that shows up
lottery
gambling,
tickets.
lottery, crypto, stock market. I mean, you name it. And trust me, I've done it. I mean, I've done the Vegas thing. I've gambled on college football games, the .com stocks. I mean, I've tried everything in my power to make a lot of money without working for it, and it has failed every single time. So, some people get lucky, and they get in at the right time and then kind of smell things out, and they're like, I think I've made money in this, and they get out, and it's like, more power to you. I mean, it's not to say you can't do that,
right?
But for the vast majority of people who try to do that, it's only going to end in tears.
Yeah, and a lot of times I think they kind of get in too late and then stay in too long. So that's where it's hard for us, because we just feel for people who are losing money in these, like when they find out or when they learn it wasn't what they thought. So it's just so hard for us to like hear these stories, because we really feel bad for them, because this is something we take so seriously for our clients. We want to invest our clients for their money to be there when they need it. And so taking a speculative risk like this just doesn't line up with so many clients. So, yeah, it's very important. So I guess if we kind of take this back even a little more, this has kind of led to like a broader discussion on risk and just investing. And, everything has a different risk. So it's funny because everybody wants to invest in different things. You have people that have never invested in the stock market. You have people that only invest in real estate. There's people that buy paintings, hard assets like this. Mm-hmm. And at the end of the day, investing, it has different risks. So when you're choosing the asset you're going to invest in, there has to be a willing buyer on the other end. And so this is where, some assets, something like a painting, it may be harder or there may be fewer buyers on the other end. Mm-hmm. So there's more risk because you don't know what the value is going to be. It could fluctuate. The economy could really affect that. So maybe touch on a little bit, if someone's like, I just like to sit in cash, or I just want to be in real estate. Are those good ideas to kind of put everything in one basket, or?
Yeah. I mean, the most basic thing people need to realize about investing is your potential reward is commensurate with the risk you take. Mm-hmm. So if you're in a really risky thing and where your chances, and when I say risky, I mean, basically think about it like, what are my chances of this thing going to zero? Mm-hmm. So the higher the chances that it could go to zero, the more risk you're obviously taking. Mm-hmm. So if you have a high degree of risk like that, you don't want to get in and earn 2% because it's like you just run the odds on that, 50% chance of a 2% gain and a 50% chance of a total loss. It just doesn't make any sense at all.
Yeah.
So, everything is, it's all about risk and reward. And what happens, I think, a lot of times in these manias that I've seen, and even just historically, is investors convince themselves that there's a lot less risk in something than there really is. So, when you see prices going up like crazy, and I shared an advertisement from one of these exchanges with some clients that were asking me about crypto a year or so ago. Mm-hmm. And I mean, these companies were out there with advertisements offering 8.5%, 10% guaranteed yields on their investments. And I'm like, well, now wait a minute. And they're presenting it as like a low risk way. It's almost like a bank. You just throw your money in and you earn interest. And I'm like, well, now wait a minute. Hold on. Banks are paying 0.01%. Yeah. And government bonds at the time were yielding like 1.5%. How are these guys offering 8, 9, 10% yields on investments, with quote unquote very little to no risk? It's like it just doesn't pass the smell test at all. So, it's just really understanding that, when you're looking at an investment that is promising a higher return, that may happen. I mean, you don't know. I mean, it may happen, but the higher the return that's being promised or the higher return you think you're going to make on it, you're definitely taking more risks. So it's just being aware of that.
Yeah. I mean, I'm looking here just a year ago at the advertisement you reminded us of. Yeah. Earn up to 8.25% and up to 250 of a crypto bonus if you just put 100 or more in your account. So it almost like makes it, it's like if it smells too good to be true or it looks too good to be true, it usually is. Like, it really usually is.
Yeah.
And so it's hard to say, like, it always is, but it really, like, these are things where when it seems so obvious, like, anyone can do it, that's where it's kind of like, I don't know, like, it seems really fishy. So, yeah.
And look, it's not, it's easy to believe these things because a lot of the way they're presented and they're always presented at a time when whatever they're selling is working really well. So when you see these things, it seems very plausible. And, again, I've fallen for these things and lost money. Not in crypto, but in previous stuff. And, it's not to like shame anyone like, oh, if you got in this. And I mean, we've all been there. We've all been there. And, just going all the way back to what we said earlier, it's kind of that human nature that as an investor, you have to understand yourself psychologically. Yeah. It's human nature to want to make a lot of money without putting out a lot of effort. So that's just
Yeah.
That's just an example of
That's
it.
great. And so now if we kind of shift when people will say, so I think there's a lot of people that would say, well, I know that I invest in the market, but I don't really understand what I'm investing in. I don't really understand how the market works, even just stocks of large companies. And so I guess even just kind of peeling that back a little bit, when people are investing, like when we are investing people in stocks of companies, those companies sell products or services that at the end of the day, they sell them for more than they're making them. So there is a profit that they're actually making on the product or service that they sell. So when we're investing in stocks, when you're investing in companies, you're actually investing in a product or service or a company that provides them that is actually making money. So that is where you now, as an investor, as a stockholder, make money, right?
Yeah, because really, investing is all about making money and investing, whether it's stocks or bonds. It's looking at how much do I have to put up today to earn a certain stream of cash flows in the future. So, everything, all the prices that we see are in stock and bond markets are based on the math of I'm going to get X, Y, and Z cash in the future. So I look at that and I say, you know what, I'm willing to I'll discount that 10% a year just because it's risky and I don't know if that's actually going to happen. And then you kind of discount all these cash flows back to today and you say, okay, the value of those cash flows is like $10. And right now I'm looking at this stock and I can buy it for $8. So that's an example of like, okay, I'm going to buy that $8 stock because I believe I'll get 10 out of it at the end of the day. So it's really about just the cash flows. And if they're not there, this is where you get into, for me, the biggest challenge that I've struggled with like Bitcoin and other cryptos. But let's just talk about Bitcoin is it's kind of like gold. What is the value of gold other than the fact that people believe there is value? It doesn't pay you a dividend. You don't get any sort of like compensation for it. It actually costs you to hold it. So what is the value of gold? Or what is the value of a Beanie Baby or Pokemon card or a piece of art? You can go down the whole list. So, it's not something like Bitcoin. I don't like delegitimize it for, it's just a sham and it's worth nothing and all that. As long as people believe there's value to it, there's going to be value to it. And I don't personally understand it, but, other people do. And there's a real market for that. So, but for the kind of investing that we're always doing for our clients is we're investing in things that actually produce cash. Because again, going back to something I said before, the last thing we ever want to do for a client is own something that goes to zero. To me, that is such a failure of our responsibility as a fiduciary to allow that to happen. Stocks in, the 1,000 stock index fund that we might have, there might be one in there that goes to zero, but not the whole thing.
Right.
We're really focused on making sure that our clients don't have their capital impaired, because if capital becomes impaired, then retirement or whatever financial goal they're saving for becomes impaired.
Yeah, exactly. It's easy, I think, to understand stocks because that's a company, there's a product, service, they're either making money or they're not. And if a company continually doesn't make money, those companies don't exist very long. Now, growth companies, if they aren't making money, they'll want to borrow money. And so this is how we have bonds, because there are people out there that say, I don't want to take as much risk. I'm willing to just lend money to someone who needs to use it, and they're going to pay me just a percentage per year in order for them to use it, but I'm going to get my money back after 5 years or whatever the amount of time is. And so that is now why we have bonds, because it's just some investors say, I'm willing to lend you my money and I'm going to get it back. So that's how we have bonds, just to basically explain those.
Yeah. Yep.
But I think it's when we really boil it down to something really simple like that, it helps people to understand. Even when I invest in the markets, in quotations, people are, would probably say, I don't know what I'm invested in. So I think that even just helps to help people at, on a very basic level of what that is.
Yep. Yeah, and the other thing to mention, this really gets into what has been going on the last couple of weeks in the crypto world, is there's investment risk, which is the price goes up and down, and you don't know what that's going to be in the future when you go to sell it. The other piece, actually two pieces. Number one, liquidity risk. That is something a lot of people don't think about. And, I always allude to gym memberships. It's so easy to get into one of those things, but goodness gracious, if you want to cancel your gym membership, you have to sign your name in blood, send it snail mail halfway across the country. They make it really, really hard for you to get out of it. And you see that a lot in finance. And, I'm not picking on anyone here, but, you look at real estate investment trusts that don't trade on the market or what they call non-traded REITs. Really easy to get out. They promise big returns, but man, every time we go through a downturn, they don't let you take your money out. So what's the purpose of that? Or, certain types of life insurance contracts. And, you could go down the whole list. Liquidity is a really big thing. And the other thing that people need to realize when they're investing in all that is just the amount of consumer protection around what, your investments. So you put money in the bank. I'm going to go to Chase or PNC or pick your whatever bank. I know I'm confident to put my money in that bank in a deposit because I know the government has FDIC insurance standing behind it. Or if I'm holding a lot of cash at Vanguard or Fidelity or Schwab, I know that there is SIPC insurance standing behind that. And there's a lot of laws, securities laws going back to the 1940s that are built on creating this system of trust around finance in our country, because if you don't have a financial system that people have confidence in, you don't have a society. And you can ask anyone who lives in Argentina or some of these other third world countries where there's bank runs and collapses all the time. It is really hard to function. So it goes beyond just the investment risk. It's, can you get your money out when you want it? And what are the protections around that as well?
Yeah, I think that's a really great point. Even if we look back to 2007, 2008, when all of these mortgages were being handed out, and you could borrow so much more than you really should have, and that was even legitimate, but it happened. And then after that, trying to get a mortgage was you had to give, you have to give blood, you have to do all of these things just to be able to get one. So it changed the standards right away because they're we can't have this happen again. And so it is interesting to watch kind of the regulations that get put in place after that, which thankfully they do, so that people can do this in a safe way and aren't being taken advantage of.
Yeah. And it's important to note, just on mortgages, even though you have regulations, that does not mean bad things can't happen. So there was a lot of regulatory failure around mortgages. And I sat in that seat of, I'm analyzing banks and mortgage companies, and I'm watching them give out these mortgages like crazy. And I'm like, how are the government regulators allowing this? It just made no sense. And at the end of the day, what happened is these companies were basically funneling money to the regulators. So, take it for what it is. But in general, having the laws, regulations are, that is really key. And that's something that, just going back to the crypto exchange. So, all these crypto exchanges are going bust. People want to get their money out. They thought they owned Bitcoin. It's you didn't own Bitcoin, and what you did own, that piece of paper is gone. So people are trying to get their money out. And the reason why all this is happening is because there is no regulation. There is no government backstop that says if you put your money into this crypto exchange and it goes out of business, we'll reimburse you up to X amount of dollars. There's none of that. So unfortunately, a lot of people are finding out what happens when you buy a speculative asset in an unregulated industry. It's really, you're you're glutton for punishment because bad things will happen.
And it takes time for those regulations to catch up and to be put in place once they actually learn what people are investing in. So, so it's if you're going to be the first one in, you need to do that research yourself. You have to be the one because someone else isn't doing it for you. Yeah, that's important. And so this is kind of a question for you, kind of going back with your experience because, you were researching kind of the banking sector. I mean, that was really one of your specialties. So someone who's investing, if they're like, do you believe that they can research, they can know what they own, knowing all the research that you did, kind of just walk us through like the extent of research and people you were talking to really understand what people were investing in when you were doing it?
Yeah. So, I mean, analyzing banks and following banks, particularly after the housing crisis, as an investor in banks, you become very acutely aware of regulatory burden. Like there is so much regulation on these things. And, in some cases it seems like it's too much, but just knowing that there is a lot of regulation out there. FDIC insurance is there for a reason. SIPC insurance is there for a reason. Can a layperson really dig in and figure out what the exact bank regulations are? I mean, you could, but I mean, that would be a full-time. I mean, I did that as a full-time job, and I struggled to keep up with it. So.
Yeah, and that's what I'm saying. So, I mean, even when you were analyzing banks, so if you were going to invest in a stock, you would probably be talking with leadership at the bank. You'd be sitting in on their earnings calls. How is the bank doing? How is the business doing? Are they making money, losing money? You're probably reading research reports from different analysts. I mean, you were probably reading and looking at a lot of stuff, and then writing up your own report and your own research to actually say, okay, yes, I think that this is a solid company to invest in or not.
And talking to the regulators themselves. That was always a key part of it as well, is getting to know the key players and the key regulators and meeting with them often to understand what their thinking is. How do they view the industry? Is it safe? Is it not safe? If it's not safe, how do they think you can resolve that? I mean, realizing a lot of people don't have the time or the desire to really do all this. And I mean, this is a shameless plug for, hey, this is what we do at FDS and everything. But I mean, this is literally our job. Like when people pay us to invest their money, we're not just going out and picking stocks and bonds and crypto or whatever and calling it a day. We filter everything. So we think about liquidity risk. We think about regulatory stuff. So if a fund is, maybe run by a company that we think is shady or might have some problems, we just avoid it. And, since I've done that for most of my career, it's pretty easy to kind of spot who the good actors and who the bad actors are. So everything we do, from an investment standpoint, from the custodian we pick to the funds we invest in, to the types of investments. I mean, all that is filtered through, can we get money out when the client needs it? And is it safe? Is there a good regulatory structure around it? And is there any chance of that thing going to zero? And if it doesn't pass those three tests, we don't ever include that in a client portfolio.
Exactly. Yeah. I love that you explained the extent of when you're someone really close investing a stock in a company, that's like a really, really close level. But as an investor, we're so far removed from being able to hear all of that information, even see it, know where to look for it, all those pieces. Sure, you can go it alone, but there's so much you don't know. And so that's really the value of what you're getting when you have someone helping you invest.
Yeah.
Yeah, that's helpful. Yeah, so sometimes we might say, we know it seems boring, stocks and bonds, but there's a lot that goes into just stocks and bonds, and even cash now is an asset class. It's a reminder we can invest in cash because it's paying something. And so depending on what the economy is doing, there's different places to invest.
Yep. Again, unfortunately, because what's going on in crypto, people are having to learn this lesson all over again. I've made all these mistakes. All I can say is the way to win in investing is to keep it extremely simple. And what I mean by that, the way we do things here is really simple. We invest in a mix of stocks, bonds, and cash for people based on their risk tolerance, based on their time horizon, and with the goal to get enough growth out of those assets and to make sure that the money is there when they are going to need it. Because whenever you're investing, unless you have a lot of money and you're definitely not going to spend it, for most people, they are going to use that at some point. Yep. They're going to have to pull money out of their IRAs to live on, or they might have some charitable goals. So, just keeping it really simple, trust me, it is the way to do it. It's not sexy. It's boring. There's going to be cocktail parties that you're going to go to in the future where people are, investing in rental real estate or crypto or the latest, whatever fad is investment. And, it kind of feels crappy to sit there and say, well, I'm not in any of this stuff. But all that stuff comes and goes. Those people end up losing money. But just like the tortoise and the hare, the tortoise just keeps plugging along and ends up winning the race at the end. So, that's our philosophy for investing.
Yeah, and I think just, we always have clients ask us about these things, and we never, directly say, no, we'll give our thoughts, and we say, here's what we see. But at the end of the day, if someone says, I want to stick $1,000 in there, we understand that's absolutely up to you, and you can do that. We may not do it for you, but you can do that. What we're trying to be careful of is it isn't everything, and we're really watching, that you're going to have enough to still accomplish your goals. But if you can do something like that, then that's outside of this. And we're really quick not to judge and not to say, oh, I can't believe that you would want to do that. We really want to explain and kind of teach. So this is really, kind of the purpose again of today is just explaining this is kind of one asset, crypto, that it's just something that it's happened before, just a different flavor in different ways. And we're trying to just help to remind and explain that anything you invest in has its own risk. So thank you so much for joining us, Rob. This was really helpful.
Yeah, no problem. Yeah, it's crazy times. What's going to happen to crypto going forward, I don't know. But, having seen these kinds of scandals during my career, I can guarantee you there's going to be a lot of congressional hearings. There's going to be a lot of regulatory pushback. So, there's going to be a lot of people out there that are like, oh, the price is down. You got to start buying this stuff. That may or may not work. I don't know. But all I can tell you is there's going to be a very, very dark cloud over the crypto industry for years to come. So, yeah, so it's been great to share all this.
Thank you. That's another great point. Yeah, that we just wanted to say, sometimes when the market's down, we say, yeah, you're investing at low levels. This may not be one of those low levels that you want to jump into and say, oh, great, I'm buying it for cheaper. So just be careful is the message. Know the risk you're taking. Yep. So thanks for that reminder.
You got it.
All right. So thank you for listening again to this episode. If you want to know more about the changes and updates as we're talking about here and what they mean, you can sign up for our email newsletter on our blog page and even just continue listening to this podcast. So thanks again for listening. We'll see you next time.
Thanks for tuning in. If you like what you hear in our podcast, please subscribe. We release new episodes every other week. And quick note, the content discussed on this podcast should not be taken as financial advice. Financial Design Studio accepts no responsibility for your individual actions or choices. But for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. We'll see you in the next episode.